Welcome to this week's Market Talk. I'm Amber Lancaster, and today I'm joined by Paul Mampilly. Our colleague Ian Dyer is away on assignment. Each week, we look forward to sharing our viewpoints with you, our readers, and giving you insight into what's on our radar. We're recording today's call on Friday, January 18th, because the U.S. stock markets will be closed on Monday, January 21st. An observance of Martin Luther King Jr. Day. I'll begin by sharing with you what I'm watching, and then we'll hear from Paul. On the U.S. economic front, we will be anticipating a flurry of economic releases to gauge the overall health of the U.S. economy. Now, due to the partial government shutdown, releases will continue to be delayed as their reporting agencies are unable to collect and process the data. And despite the delays over the next week or so, we can expect several vital print releases, including new home sales, construction spending, factory orders, durable good orders, retail sales, and housing starts. But of all the releases, one that's most top of mind for many economists is the GDP number. An interesting take on the effects of the partial government shutdown on first quarter GDP was just released by Bloomberg Economics. Their consensus is that the risk to the economic outlook remained contained and estimate that macroeconomic impact will be manageable. The estimate is 0.3 percentage points of the expected drag on the first quarter GDP if the shutdown were to exceed past the end of this month. And just this morning, in a speech, New York Fed President John Williams stated that interest rates are closer to normal levels and inflation is tame, and that the approach is one of prudence, patience, and good judgment. So overall, he doesn't see worrying signs of inflation pressure, and that the economy is strong, its outlook is healthy, and his numbers, one priority is using monetary policy to keep it that way. So in short, what he's doing, he's watching, he's listening, and he's prepared to adjust his viewpoints depending on the data. Now, on the technology front, the world's largest retail conference and expo just wrapped up in New York City this week. This conference was attended by 37,000 people, 16,000 retailers, more than 800 exhibitors from 99 countries. It's the National Retail Federation Big Show. And it's a fantastic gathering place for exhibitors to showcase new innovations in the retail sector. And of course, our constant theme here at Bold Profits Daily is the Internet of Things, IoT. And the paradigm-shifting technology of IoT was on full display at the conference. It was reported also in Bloomberg News that a partnership between Microsoft and Starbucks is emerging where the coffee chain's brewing machines are concerned. Within the coffee house's brewing machines, there's a small device installed in them that contains a chip, and this chip will be Microsoft's Azure Sphere chip. And these chips connect the coffee machines to servers so new recipes can automatically be transferred to them. Now, before this innovation, twice a year, Starbucks had to upload the recipes to USBs, the little small thumb drives, about 8,000 of them, and literally have them delivered by regional maintenance techs to the stores across the country. But with this new technology using IoT, its innovation is astounding. That will cut down on literally so much legwork in delivering these USBs. So that's what I'm watching this morning, and we'll pass it on to Paul. Tell us what's on your radar.
Thanks, Amber. Love that story about Starbucks and Microsoft. I have always felt that people think about innovation in terms of technical thinking, in terms of like as if it's about the technology, but innovation is really about making our lives better, easier, more convenient, cheaper, and making things that we want to do more accessible. And that story is just perfect because, I probably couldn't survive without coffee daily, to be completely truthful. Anyway, I've got a few things that I want to mention. So this morning, The number one macro thing that I pay attention to that's really important to me is industrial production, because it really tells you what a country is making in real terms. And so this morning it was announced that industrial production for the United States grew by 0.3%. Now that sounds tiny. However, that's about what you would expect it to grow most months. And given what the stock market did for the last 3 months of 2018, it's clear that some number of people thought that industrial production was going to fall off a cliff. And it actually grew. On an annual basis, industrial production or output grew at 3.8%. And even within the report, there's lots of really great signs. Manufacturing output grew 1.1%, and making of motor vehicles, which is a very weak part of the economy for most of 2018, actually showed gains. And capacity utilization, which is another number that I keep track of, which is, the percent of the factory that's actually used, rose to nearly 79%, which is the highest level in 4 years. So these are all incredibly optimistic signs that really there is no great crisis, there is no great problem, there is nothing of any major magnitude that is currently out there. And so, as I mentioned last week, I'm incredibly optimistic because this really confirms a lot of what we have been hearing from companies on a standalone basis, which is that things are going actually pretty well. Yes, there's a slight slowdown associated with the trade war. However, there is nothing that is so drastically wrong as what you might have imagined based on seeing what the stock market was doing from October through December. And in truth, in my experience, I've seen the stock market get things wrong before and then just turn around and correct itself. And that's what we have seen really since post-Christmas, which is the stock market has just turned around and gone straight back up, pretty much in a straight line. So it's one reason why in our services we have guided people to stay in there, because the facts were telling us that there was nothing wrong. So other good news that I'm tracking is that interest rates at the very peak in 2018, if I use the 10-year U.S. Treasury bond, were as high as 3.25%. Today, if you look at it, it's 2.5%. And that's also very stimulative to economic growth. And if you look at mortgage rates, which is something else I track, at the high of mortgage rates last year, you would have gotten 5.25% on a 30-year mortgage. That's down to 4.5%. So that's stimulative to housing, which, even though it's a small part of the calculated part of the economy, it's an important thing in terms of the overall growth because it has so many knock-on effects for lots of businesses. And the same thing with auto manufacturing as well. So lots of great signs. Last thing I want to touch on, and then also introduce something to all of you that's super exciting, that we're interested to see what it shows up, is that you know that I have been referring to the U.S. stock market and, in truth, the total world as being there's the world of the old, which are old ways, old companies, old services, old products that are slowly but surely going away. And I've mentioned Sears as an example of a company that represents the old. And then there's the new, and largely Bull profits and all of our services are invested in the new. And you saw this week another example, even when an old company does well, the stock largely doesn't do anything. So, for example, American Express, which is an old world company, it's been around a long time, represents payments associated with iconic cards. They actually had a very good number. However, nobody came to bid the stock up. And that's because people realize that the competition for American Express from financial technology companies is rising every day. There are companies out there that have got American Express in their target scope. And so people disbelieve American Express can actually continue to do well when they're facing so much disruptive competition that's coming. And so this is once again an example of the old and the new. And last time I mentioned Target, where even though they did well, the stock price went down. And once again, you're seeing the same thing with American Express. So one thing that Amber, Ian, and I have worked on is that we have taken all of our stocks across all of our services. So these are Profits Unlimited, True Momentum, Extreme Fortunes, and the $10 million portfolio. And we have put them all and we've equal weighted them and put them into an index, which we're calling the Bold Profits Disruptification Index. And year to date, and we grant that it's been a very favorable environment for this index is up 11.8% compared to 4.5% for the Dow and 5.2% for the S&P 500. So very small sample. Yes, it's super favorable to us. Still, we are totally destroying the competition. So we'll try to give you regular updates on the Bold Profits Disruptification Index because it will give you a measure of the old versus the new. And so super exciting stuff for you that we're going to have for the rest of this year, something to look out for. All right, back to you, Amber.
Thank you, Paul. Yes, exciting indeed. And I want to thank each of our listeners for checking in with us today. And we shall be back next week with our next update. Have a great day, everyone.